Well, we knew we would get here, right? This is part of our base prediction is that inflation is not only here to stay, but it's going to continue to get worse. And why wouldn't it? It's baked into the cake, you guys. I mean, especially food. How long have I been talking about food and the reasons and catalysts for food to continue going higher, whether it's the lack of rain or the floods, right? Or the fertilizer or the combination thereof. I mean, there are a lot of reasons that food prices haven't even started going higher yet. Not to mention the food itself, but all the byproducts that come from food, whether it's the leather from the cattle or the wool from sheep, right? Or it's the things you get from the vegetation like the alcohol or starch, cotton. There's plenty of byproducts that come from all forms of food that are all going to go up too. When food prices go up, everything prices go up, okay? So this is all baked into the cake. It's only just started. This year's crops haven't even made it into next year's prices yet. Believe me, there's still more to come, especially in livestock, especially in cattle, for which there's already a shortage, whether because the ranchers got rid of their herds early, didn't keep heifers that they maybe would have kept and bred to come up with more cattle because they were too expensive to keep, or because they lost to dehydration and the drought. There's lots of reasons, lots and lots and lots of reasons. It's a very complex issue, but all those reasons are real, and they're part of the fundamental reality that we live in of why so much inflation is baked into the cake. And by inflation, we mean, of course, higher prices. Although inflation really and truly is the expansion of the money supply, which leads to higher prices.
You simply flooded the system with money.
Yes, we did.
So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digital.
Flooding the system with money.
Yes, exactly.
And there's no end to your ability to do that.
There is no end to our ability to do that.
Now, some of these higher prices are a result of supply side issues, which is true. But notwithstanding, you have to understand that the free market would fix these things in and of themselves. But because we're going to continue to print money like they're already doing in Europe, right? They're already printing money to subsidize energy, right? Which is maintaining the demand in a global energy crisis, which there is a shortage of energy, right? Or just like they're doing in California, they're printing these $1,000 gas cards, right? To help people buy gasoline, which helps keep up with demand, right? Which pushes up prices. So it's not just a supply side issue causing these higher prices. It is inflation of the monetary supply through printed money that's helping demand maintain itself when it should be on the decline. And this is a common mistake that's happened, all throughout history. So in nations gone by and generations gone by, empires long gone, all of these politicians made the same exact mistakes that our politicians are making now in times past, right? And that's how this is so easy to predict, is because we know what they're going to do and they're already in the process of doing it. And you also have to understand, how the hell is inflation going to go away when the Fed is powerless to do anything about it? They can't raise rates high enough to stop inflation, because they can't take rates higher than the rate of inflation itself. Because if they did take rates that high, then they would force the federal government to default on its national debt, which, by the way, if the Fed raises rates one more time by at least 50 basis points, the interest payments on the federal debt as a fiscal yearly budget line item, okay, will not only exceed $1 trillion, okay, but will become the single largest line item in the budget on an annual basis. So I'll say that again. If the Fed raises rates by 50 basis points just one more time, then the interest payments on the national debt will not only exceed $1 trillion, but will also become the single largest line item in the budget on an annual basis. This is unsustainable, guys. They're at the end of their rope. They can't keep doing this, okay? So they have no choice but to pivot. But to reiterate, I don't think the pivot is a good thing. I know a lot of people are waiting for the pivot in anticipation of it being some kind of catalyst for the markets to run higher. And at first, they probably will. But I think in the medium to long term, people are going to recognize that for what it really is, which is a capitulation by the bank itself to a larger issue, right? Because something is either broken or they've run out of ceiling. And both of these things are equally egregious, right? Both of these things mean that more pain is coming in worse ways. In particular, that we have accepted inflation, that inflation's here to stay and it's going to get worse. And this is going to hurt earnings. This is going to hurt the consumer. And wages can't possibly keep up with the inflation that's coming. And so this is going to spiral out of control in its own bad way. And remember, the reason that this is all coming to a head is that, for all of the MMTers, right, the modern monetary theorists and all of the Keynesians who say, well, look, they've printed $30 trillion already, $31 trillion already. This is proof that they can print all this money and get away with it. Well, this is proof that they can't, because all of this is coming to a head thanks to this global energy crisis. So if you don't understand it already, they have gotten away with printing all of this money for this long because they've been able to grow their way out of it, right? So as they've grown all of this debt, they've grown the GDP along with it, right? And it's kind of helped them even it out a little bit. Even though it's the debt's grown faster than the GDP, that GDP has offset it, right? So it's allowed them to get away with it. Well, the problem is now that we've gone to war with Russia, we have sanctioned Russia, the world now lacks her supplies, especially her oil and gas and energy. And because we have the political stupidity and domestic issues of not tapping into our own oil and gas supplies here at home, or largely in the West, right? All the mistakes we're making here in the United States are making all throughout Europe too, right? So they're not tapping into their own reserves wherever they may exist to be energy independent as well. Everybody has foregone all this stuff, and we have lacked the investment and input into these resources on the backs of this ESG green narrative, right? And so we are now stuck in a corner, right, where the federal debt continues to grow as all of a sudden the energy to grow the GDP has leveled off. And this is why everything is starting to crumble all at once, all at the same time. It's not like there is some magic thing out in the universe that caused this all to start crumbling at once, except there was. I mean, it was the sudden choke point of energy, right? Because you got to appreciate that for every barrel of oil that these governments consume or these nations consume, it has a 1-to-1 correlation with your GDP, right? So the more oil a nation consumes, the higher its GDP is going to be, right? That just kind of makes sense. It's more output. They're outputting more. Well, all of a sudden, if your debt's going up like this and your oil supply gets cut off, well, then obviously your growth gets stuck here as your debt continues to go up. And now you have a problem, right? And this is why everything is starting to break down. It's energy. And so they have met their match. And there's really no way to turn around from this thing. They have too much debt to raise interest rates to a meaningful level. They don't have the energy to grow out of it. And of course, if and when the Fed does pivot, they have capitulated to inflation, allowing inflation to run rampant in exchange for saving the economy and preventing a depression. Of course, a depression is about the only thing that could save the economy in the long term, because if you do save it now by allowing inflation, you're just kicking the can down the road longer before it all collapses. Anyway, of course, that's what they're going to do because, if you're in power and you're a politician, I mean, are you really going to allow things to collapse under your watch? Or would you do everything you possibly could to kick that can one more time? Obviously, they're going to kick this can one more time, and they're going to do it by capitulating to inflation, which the sneaky thing about inflation, by the way, is the government needs inflation. The government actually profits on inflation. The higher you go up the totem pole, the more you make on inflation. And with the government and the Fed being at the very top, they make the most out of it. In fact, the most reasonable way for the government to make it out of this sovereign debt crisis is to inflate it away. Okay, but you can't inflate it away if you run your economy into a full-on depression, right? So really, there's one or two ways out of this thing: depression or inflation or stagflation. And, it just makes sense with all the historical analogs that we have that they're going to choose the route of stagflation because they're just not going to allow people to suffer to that great of extent. And because we're already seeing them react the way they are in places like Europe, I mean, they've already given us the signpost. They've already shown us their hand. We know this is what they're going to do. So it's all over but the crying. It's just the waiting game now. And because we can speak from a place with such confidence, we know how we can invest accordingly, okay? And this is going to be largely commodities, especially energy commodities like oil, potentially uranium, and of course, gold and silver. Okay, guys, so this is a pretty good table that I wanted to show you. I got this from Luke Groman from Forest Through the Trees. And what this table is going to do for us is help us understand visually how much time is left before we really take the next step in this sovereign debt crisis and the unwinding of these currencies breaking down. Because what you're seeing here is a table of individual nations. And what it's really telling you is, look, they have X amount of FX reserves. So think U.S. Treasuries. And if you divide that total by their burn rate in terms of months, then you can deduce how many months they have left before they run out, right? And this is an important question. This is a good piece of data to know and understand, because if you understand what's happening around the world right now, what these nations are doing in this energy crisis as the Fed tightens, right, as the Fed raises interest rates, is their currencies are all collapsing because they're way behind, right? So what they're doing is they're burning through all of their treasuries. All of their treasuries, they're burning through them in order to save their own currency from collapsing even faster, right? Because as this energy crisis unfolds, it becomes kind of an account deficit for these governments. So if they burn these treasuries, that's one way to fill the gap, all right, in terms of energy, because they don't have to go print money and buy dollars. They just burn through the treasuries, right? Well, that's all well and good until you run out of treasuries. And this is what's telling us is how much time they have left until these nations will be forced to make some hard decisions. One of which is, if you maintain the status quo in the current system, you're going to have to go out and they're going to have to print money in their local currency and then take that currency and go buy dollars with it, and then take those dollars and then go buy oil. All right. And this is going to just destroy these currencies, and really just, it's going to be a kneecap kind of blow for these nations. All right. Another option might be is if they go deal with Russia instead. Okay. Because Russia might reach out and say, look, you can go and print all this currency and go buy dollars with it, or you can just work with us directly and you can buy Russian oil with your local currency, but we'll settle it in gold. I mean, this is just an idea. It's a speculation of something might happen, but what if it does? Right? This could be a really big deal. But the thing about it is that, as you can see, on average, most of these nations only have 2 or 3 months, especially in Europe, until they run out of reserves. And 2 months from now is going to put them in the dead of winter, okay, when they're going to be their most desperate. And so it stands to reason that here come December or January, things are going to get really hot, okay, really hot in Europe, all right? And it's not going to be the snow. It's going to be the currency that's going to be on fire, all right? So just pay attention to this, because this gives you a really good idea how much time is left before we get to the next kind of link in the chain here as this thing starts to unwind. This is really bad. This is bad news, okay? And, it's coming down. Something's going to hit ahead on this thing, right? Something's coming to a close on this. And this might be where you potentially see the true change or end of existing paradigms. It just really depends on how desperate these nations are by the time we get there. But they don't have a lot of reserves, as you can see, at their current burn rate. And as energy goes higher, as the dollar goes higher, these burn rates are actually going to shrink, or they're actually going to grow, and the times are going to shrink on. So tick-tock. Okay, guys, starting with the bond market today, obviously yield spiked quite a lot. The 10-year got up to a little over 4% today. That's a major level. It's a major psychological level, too. What interests me the most about the bond market today is that while everyone is beginning to really understand how illiquid it is, I will remind you that the Japanese selling of U.S. Treasuries just a few weeks ago managed to move the 30-year by 3%. That was only $21 billion worth of treasuries they dumped, and they moved the 10-year by 3%. That's a big deal. It shows you how illiquid things are. And to start the day the way that we did, to have these yield spike, only to have them essentially reverse about an hour and a half after the start of the trading day, it's kind of a big deal for me to have seen that happen so early. And even more than that, you see it across all time frames, right? And it correlates to a major ramp and turnaround on the broad markets. It really begs the question of why. What happened here? I mean, you saw the 30-year get up to also kind of this psychological number, 4%, where they immediately turned around. Now, you'll see that as you ramp up in yields, I mean, you always have upper wicks. There's no real takeaway from that in and of itself. But if you think about when it happened during the event that was ongoing and the turnaround that you saw in the broad markets, it really does kind of beg the question of what happened and why did that happen? And I can come up with two guesses. The first might be is that, the markets may be kind of realizing that the Fed has no power to fight inflation and that all they're really doing is nuking the economy, and it is now a vote of no confidence in the Fed. So get the hell out of the way. Your chance to rein this in is over, maybe. The other possibility is that, the markets were so oversold with people positioned for more downside that you may have got some kind of anomalistic squeeze here. I don't know that for sure, but certainly today was abnormal. Something happened today, and we really need to see tomorrow to know for sure. So likely I'll end up making another video tomorrow in the price action to follow up on that, because of right now, I think it's too early to say unless I'm able to find more data before this video is produced. I think it's too early to come to a conclusion of what happened, but I can tell you what I think about price action and what the levels are. So starting with the S&P 500, look guys, today was nuts. So you started here, right? You dropped to open the day 2.4%, only to finish up 2.6%. That's a 5% swing. That's massive. And you'll notice also the body of this daily candle pretty much engulfs the prior 3 days of trading. It's pretty nuts for a broad index to look like this. And you'll see the clear ramp up in volume here today. A lot of interest in the markets today. But what's more interesting is when you come to the weekly time frame, you'll see that this is now critical. The 200 moving average is where we rallied up to, slightly above and then closed below. Okay, so far we tested and have somewhat been denied this 200. This 200 is everything now, and this is going to apply to all of these indices. If the S&P can't manage to get above this or hold it on any kind of retest, it's over. I'm telling you, it's game over. It's going to collapse. You're looking at least the 3,400 again. That's always been the original target. We got down to 35. I'm not sure that's going to be enough. The real test is going to be holding this 200 on the weekly. The same thing is true on the Dow. I mean, look where it is. It's at the same equivalent spot. All right, so you're now trying to get back above that 200. You don't do it, it's bad news bears. It's a long way down. I think that's what we're looking at in the near term. Now, if we zoom back in on the daily time frame, you have a bit of a double bottom pattern here, okay? So your first test is going to be right here at about 38.20. And by the time you get there with the momentum we have, you'll probably have some correlation of the 50. So you'll have a double confluence of resistance right there, right? Makes sense. So let's look for 38.20 on the S&P as a near-term upside target, where if you get denied on this kind of potential double bottom here, you're going to do really what uranium did and just roll back over. And that'll probably be when you lose the 200 again and you ultimately go down lower for the longer term. Really the same thing is true across the rest of the space. And if you look for more confluence in bellwethers like AMD, for example, so you'll see this blue line is where the price ended for today. It happens to be exactly where our horizontal support is. It closed exactly there. So this is significant because not only did we lose this key support, we have tried to test it for several days, getting clear denials every day. And even after the major ramp today, all right, you managed to peekaboo above and close at or slightly below. This is going to be another tell. So you're watching AMD to see if it can get above, $59. Okay, failure to get back above here. I mean, you're looking at more downside again. It is interesting that all of these equities are kind of holding their same equivalent spots here to get back up into a positive territory. which is to say that after everything that really happened today, all of this wild price action, the markets didn't actually gain any ground at all. In fact, they kind of spun their wheels in the mud. I think that this is a very noisy day. I think bears are seeing what they want to see. I think the bulls are seeing what they want to see. This market kind of has something for everyone. Creates a lot of uncertainty. A lot of people are going to lose a lot of money trying to play around with this and get options and stuff. They're going to get killed. Now's the kind of time where you just step back and wait. Get another day of follow through. See if we can break above these immediate levels of resistance to the upside. Because if we don't, that is a clear tell that we're coming back down, and we're coming back down in a big way. That's what I'd be looking for in the near term. Okay, guys, starting with gold and silver, we'll start with the spot prices here on silver. I just want to remind you guys that 21.45 is the level to break if you want to go higher. I know everybody has all these numbers, but all you have to do is zoom out and just look at how many major important touches we have at 21.45, not to mention the two moving averages, the 50 and the 200, that have confluence at that same spot. You are not going higher until you break 2150 and do it convincingly. That is the upside target to beat. So again, we're looking at the weekly chart. It's disappointing to see not perform a little bit better, but what I can tell you is that until you break this low right here, you're technically still in an uptrend, okay? So just give us some time to see what it does. It's just a wait and see with silver right now. It has strength. Nothing is broken on the RSI. Everything looks pretty good. It's just had a down week. So let's give it a chance to follow through. I will tell you that gold looks a bit better. It continues to hold these major trend lines, on the weekly, on the daily. It keeps peekabooing and settling above where it needs to. So you are starting to run out of time. You'll notice that we have a hard time on the daily getting above this 50. Okay, and now we're coming to an apex here between the 50 and this long-term support. All right, so one of these two have to break. It's got to make a decision. So I will tell you this. Right now, the plan in gold and silver have not changed. I think the only way you break down and lose these key supports like this is if you get a liquidity event, in which case everything sells off. When that happens, it's likely because something has broken. This is exactly when and for what reason you want to own gold and silver anyway. So I will try to catch the knife here at 1550. I expect that would be the capitulation low, and I would expect a V bottom there, no different than this right here in March 2020. And that is exactly what I'm looking forward to, okay, in the event that we get the sell-off. But if we don't get that liquidity event, nothing has changed. I think that we have already put in the low. I think we have already put in the pivot bottom. So all you have to do right now with the spot metal prices is just to wait and see what happens. I think it's a bit more encouraging when you look at the equities themselves. So let's go take a look. Okay, so the gold and silver miners are actually getting really interesting because they're trading in complete confluence with each other. So despite the metals prices behaving a little different, you can think about silver's 9% run that day. I think gold only moved like 0.5% or 1% that day or something like that. There's some strong discrepancies there between the movement of the metals themselves or the levels of support that they're holding, etc. But the miners are actually trading in strong confluence with each other, and they're actually putting in some potentially very bullish patterns. And the reason why I'm going to give this a lot of credibility here is because we're seeing it across the board in all of the equities in confluence. And not only are we seeing the patterns themselves play out, but we're seeing the way that they're playing out occurring the same way. So we'll start with SIL. You can see quite clearly that we are putting in a potential inverse head and shoulders pattern here. Now, what's interesting to note is that the left and right shoulder are almost always being formed on key horizontal support here where you can potentially round up and make your way up. All right, so that's something to note of interest as well. Let's go to SILJ. It's the same thing, very clear. Looks quite good. It's hard to miss this one. Very clear, very triangular, very uniform. Looks really clean. I like what I'm seeing. That looks good. GDX, same thing. Its neckline is actually our pre-existing horizontal. And so you can see the potential right here very easily, right? Looking pretty good. Plenty of room for that to play out. Same thing with GDXJ. You go down the line. You get to AG, and you could draw it here too, but really what you're seeing in AG is a couple of really positive things. First of all, you're still managing to ride and hug and stay above this 20-year support line, okay, which has been critical to this equity in its entire history, all right? And so you're still holding it and playing with it, staying above it. You're staying above the 50 on the daily. So you're turning this moving average, right, and you're starting to flatten it out and starting to roll it up. You are slowly and gradually building a fat base right here in AG over time. I think we've already bottomed, honestly, on this one. I think the bottom was down here. I don't think you break those. I don't think you break these lows and set new ones. Maybe in a liquidity event, maybe we break down and retest them. Maybe. I'd be a hard buyer if we would, but I'm not so sure that you would make new lows from here. You've got a nice flagpole pattern here with a potential pennant, and it's all going the right way at the right time. I like what I see. I like what I see in AG. AG is very promising. The way it's going, when you look at everything in Confluence, nothing is wrong on the RSI. All time frames look fine and healthy. You know, I like what I see here, and you can just see how we're kind of basing out. And basing is really good, especially when you put in a kind of a big curve like this, you see? You're kind of putting in one of these babies down here, and you're doing it along the strong, historically important trend line. I like this a lot. I'm very bullish. I think we are well on our way. I think this all looks very good. You look at something like Pan American, and it's kind of doing its own thing. Again, if you were to get a sell-off here, I think $14 is still the place to buy. That's where I'd be looking for myself. Again, in something like Silvercrest. Now, look how pretty this is. Look how pretty Silvercrest is. So we'll put back in our neckline right here, and it's clear as day. It's clear as day. Look at this. Left shoulder, head, right shoulder. You're forming both shoulders on this strong horizontal support. Very clean, very triangular, very fluid, extremely healthy looking chart. I like it a lot. This gives me a lot of confidence. And, you know, again, when you see everything playing out in uniform in Confluence like this, it really gives you a lot of confidence to play it, certainly to keep an eye on it and see if it plays out. Look, it's even playing out in Agnico Eagle, right? So it really doesn't matter what the name is or the space. They're all charting out the same way. This is a very good sign because we really haven't seen this degree of confluence in gold and silver pretty much this whole time. I mean, they've kind of hit lows together and traded mostly together, but putting in the same patterns at the same time, this is a bit unique. This is getting to kind of where uranium has been in the past, right? Uranium trading in Confluence. Now gold and silver together are doing the same thing. I'm very encouraged by what I see. Now, you know, on the downside case, maybe you don't get the head and shoulders playing out. So, you know, always have more than one option. So option number one for me is to see this play out, okay, and roll up and break to the upside. Option number two is we get some kind of a liquidity event and we come down and test recent lows. So whatever it is you're interested in buying, whatever the name is, just check it out and see what was the prior low, and that would be an excellent target. Okay, so that kind of covers all of your bases on where you should be accumulating. I would still be accumulating right now all the way back down to an anticipated bottom. You can look at it on an equity by equity basis, or you can look at it on a metals basis. Again, I would be looking for $15.50 in the gold price to the extreme downside, maybe $17, $16 in the silver price to the extreme downside, buying equities once we meet those targets. Well, guys, let's talk about uranium. I will tell you that, you know, it had a nice rally today, as you can see on the right side of the screen here, that pretty much everything is green, and it's up, you know, 5-6% say on average, so that's quite good. But this is the case for most things in the market, whether that's AMD or TMC and things that have recently had terrible earnings. So I don't think that it means much that uranium had a positive day. In fact, I just think it goes to show that uranium does whatever the broad market does. It's just a copycat. It has no legs of its own. However, there is a lot of chatter today about SPUT performing very well, and it's, you know, kind of making a lot of news. Well, SPUT was up, you know, 5-6%, just like everything else. So what's the big deal? I mean, it did what everything else did. So why is this a big deal? I mean, because it broke this level right here that was resistance. Well, it's done that before and it's failed to hold it. And you also have, at least in the short term, some possible divergences happening already. So can it follow through tomorrow? Well, it's worth a shot, but I can tell you that the probabilities is that it doesn't look too good to hold, at least not yet. So I think people are getting a little bit ahead of themselves. The move is going in the right direction, and you did have an uptick in volume. And so I will tell you that does look good. It does. All right, that does look good. That's how, that could be the start of something nice. But until you follow through, you can't. I mean, dude, you got to be patient and wait. And the problem with uranium is, like I said, it's this. All right, it's like the best time to buy it, nobody wanted it. And now when it's like putting in head and shoulders, as the broad market has really no reason to continue rallying, and it's pegged to the broad market, you've already had 90% of your fundamentally bullish tailwinds presented to you already. They're already in the sales. They're already known. They've already been announced. You've already got the Japanese restarts. You've already got all this bullish news. It's like, how many catalysts are left to accelerate uranium, right? It's like you already have 9 out of 10 of them, right? So it's like, if you can't get out on your own by now, when are you going to? And it just makes it extremely risky to continue buying right here and call it the middle of a descending channel on a bearish head and shoulders pattern. It's like, it doesn't make any sense, dude. You understand? Like, you understand the logic behind what I'm trying to tell you? It's like, if you want to buy more, I will agree with you if you buy it at the right time, because in the long term, if you zoom out, I bet this baby is going up higher, right? I bet it is. But that doesn't mean you should just be buying right now. You kind of missed your opportunities. Your buying opportunities were along these trends, okay? And if you're new, don't worry about it. Don't FOMO. You'll probably get another opportunity. If this head and shoulders breaks down, guess where it's going? It's going to come back down to this trend. And that probably would be another buying opportunity, right? So, and there's nothing wrong with that. That'd be a good thing. But buying right here in this macro, in this environment, is a bit foolish, especially after a day like this, which really, equivocates to a total nothing burger. I mean, the broad markets rallied on a high CPI print, and, uranium went with it too. And, the volume wasn't impressive. Nothing was necessarily impressive. Cameco has still fallen out of its bull channel. We'll have to see if it can even get back up here to test it, if it's able going to get if it's going to be able to get back in. As of right now, we don't know. But that sucks. That's a big thing. And a lot of the algos are looking at this and reading this as a breakdown in Cameco. So you really need more time to see how this goes. Sure, it could rally from here. Sure, it could go to the moon from here. But what I will tell you is that there are no buy signals. I'll tell you, in the short-term time frame, you can see divergences like this. Okay, that's a bullish divergence. All right, and that's telling you that at least in the short term, you can expect higher prices. All right, but whether or not it can break resistances, that's a different story. I mean, you have a confluence of major resistances. NextGen has always had a hard time getting above this 200. And it keeps going lower and lower and lower and lower. And it's about to correspond, with 2 others at the same place. It's just, uranium is simply getting to the point where it has to do something soon, or it's going to be in trouble, right? And it could happen. That news could come. It could happen. But, you had this failed inverse head and shoulders pattern, all right? A failed pattern that I warned you guys about. I encourage you to sell up here. When you fail a pattern like this, guys, it's hard to imagine winning after that. I mean, it's pretty bad. So even though you managed to come all the way back to trend, you're now putting in a potential head and shoulders pattern, which is pretty crazy. This is pretty crazy to see like that. You don't see that too often. But for now, again, look, guys, you just have to wait and see. I mean, even on the daily time frame, something like energy fuels, you essentially have 3 moving averages to get above on the daily, and then on the weekly, you can see that you're getting denied for a couple of weeks in a row. So actually, for a month, getting back above that 50, right? And so you're descending downwards over time. It just doesn't look so good. But the 200 is rising to catch you underneath, so that's nice too. And so again, just to reiterate in summary, is that I am bullish on uranium long term. But there's just no way in hell you can be buying this stuff right now because, one, there's no buy signal, and two, it trades too much with the broad markets, and three, the broad markets have no real reason to rally. Even if they're betting on a Fed pivot, the Fed pivot is largely, in my opinion, going to be negative for the broad markets, especially once the broad markets realize how much that's going to account in the acceptance of long-term inflation as just a way of life now. And look, companies like Cameco and Kazatomprom, companies that actually mine and have product and have cash flow, these companies could still do really well. But the idea that the rising tide is going to lift all boats, a lot of these companies aren't even in production. A lot of them are still in debt. I mean, it just doesn't make a lot of sense. You really got to be careful, I think, what you own in the uranium space. I think a lot of people own a lot of these crappy explorer type companies are going to get hosed for the long term. But if you own something like a near term producer, with low cost, like a Global, maybe a Denison, maybe a Cameco, things like that, maybe you can beat the system, right? And that's probably where you should be accumulating. I think if Cameco can touch $20, maybe $18, I'll be all over it. That would be a great buy for me now. I mean, in the past, I was looking at this trend line about $23, but that was all things being equal. All things aren't equal anymore. The game has changed. I mean, the world has changed. Now they bought Westinghouse. They did it for what? I think $21.95 on their share price. You just have to see. You have to give it more time. I mean, look at the volume on this. I think it was close to most all-time volume ever in a single day. And, you got to give it time to kind of consolidate and see what it does next. It's not a buy yet. You could easily come down to $20. All right. You could easily come down to $20. And if the broad markets do roll over in a liquidity event, you could see 18. And let me tell you, you see $18 in Cameco, I think you strike. I don't think you think twice about it. All right. I'll be very bullish. Cameco, $18. That's 20% away. All right. So if you must be in uranium because you want to have your seat at the table and not miss the boat, okay. But just understand maybe you have 20% of downside left. So maybe don't go all in. Maybe save some cash in the event that you do come down here. Okay, because you might not. But maybe you do. All right. But I think $18 now is a strong level for Cameco. I'd be a hard buyer there. 16 at the absolute minimum, but I'm not sure it gets that far. I think somewhere between 20 and 18 are going to be that's your buy box. And to check on some of these head and shoulders patterns that were already starting to play out. It is interesting, I will tell you, that failed breakdowns are quite powerful in the opposite direction. So in the case of LEU, where you already started to get the break of this neckline and you have turned around, it's worth watching. Okay, because if this results in a failed breakdown, then you could go back to $55. All right, so I will say that much. The problem with it is that there was really no volume today. So if you were going to get a strong rebound on a false breakdown and a reversal, you really need the volume to confirm it. So this is another one of those situations where you want to wait another day and just see. I think between tomorrow and Monday, we'll have all the answers we need. I don't think this is going to drag out too long. As volatile as the markets are right now, and as sweaty as everyone is, we're going to figure this out pretty quick. But I will say that it is a positive sign. Okay, I want to point out a positive sign to you that maybe it does false breakdown. Maybe this is a sign of what the rest of the market is going to do. Still not going to tell you to buy SILEX. You haven't even hit the 200 on the daily, let alone the 50 on the weekly. You cannot buy SILEX until one of those two things happens at a bare minimum. So nothing has changed there. This thing is a long time coming, and people are still very stubborn about it. Obviously, it's hanging on for a long time, but it's going to get there. We get closer and closer every week, so just be patient. Okay, guys, we're going to run through agriculture very quickly. We're going to do it quickly because nothing has really changed. But just for the sake of reiteration, we're looking at the larger companies like your FMCs, your John Deeres, your Grangers, to kind of help us get a bellwether of the agricultural kind of industrial sector as a whole, and to kind of help us gauge kind of confluence of where we are and kind of what the bigger names are doing in the space. And what I can tell you is that nothing has really changed because they're all testing kind of key critical levels right now, but the testing is not over. We still need to see more follow through. And pretty much on all time frames, I'm not convinced that this is a time at all to be buying. So I think that for the sake of agricultural stocks, especially things like nutrient and stuff, you still have to wait. There are no buy signals yet. It is nice that it's holding this 50, but can it do it, again next week, especially if the broad markets roll over? You really need to see this kind of stuff. It's too early, especially on the small term time frames. Remember, we lost this long-term support. We came and got it back and lost it again. And now we are getting denied on the 50. We can't get it back above that. We're rolling over, putting in the death cross potentially soon. It just doesn't look too good. You're also getting divergences on the RSI in the short term. So at the bare minimum on the short term, we're still going lower. So I would continue to wait. Intrepid Potash, again, we had kind of this ugly, funky head and shoulders deal going on here. We need to wait and see what this does too. I can't be confident to recommend a buy in this until it breaks something key, until it does something rather convincing. And right now, it's still in a wait and see, especially with the broad markets the way that they are. It's just not convincing. So you can, look at this. This is putting in already, it's going to put in the same kind of divergence when it gets back up here on Corteva on the weekly. So I would have to imagine that this thing is going to roll over too, even though it kind of looks like it has this inverse head and shoulders thing going for it, right? You see that kind of? I don't think that's going to play out, not with these divergences, right? That's not likely to happen. But certainly we'll keep an eye on it and see. I think that if it were to break, it would probably do something crazy and then come back and give you another opportunity there anyway. So it's not something I would FOMO anyway. I would continue to watch, continue to be patient, don't do anything crazy.